You brought up the Fed and what the Fed is doing right now with interest rates, with inflation. All of these things are at play. It's probably the biggest story for the markets right now. What do you want to hear? You have your own thoughts on this coming into this.
Well, it's basically, I've been taking the point of view that nominal earnings are going to be quite strong. Like the headline yesterday on GDP down 1.5%. But when you look at the net imports, which subtract from GDP, it's a very robust GDP in real terms. But the nominal is what companies do in terms of earnings. Nominal earnings are going to be quite good, quite robust, except for some of the headline numbers. But every company is worried about supplies. Companies tell me, can I get it? What price? I don't care. They're bloating up their inventories. Now, earnings are okay, but that's not the issue. It's the multiple of earnings. And multiple of earnings are a direct function of the way interest rates are going to go up. Becky, and the Fed going to 185 today on the 10. 40 years ago it was 14 7/8 on a 10-year. So the impact on multiples over the last 40 years has been a huge tailwind, and now it's a headwind, and that's what the market has to adjust to. And what Warren talks about in his annual report, which we all do, on certain types of analysis, earnings before interest, taxes, depreciation, and he then looks at CapEx, and what is the company really's earning power? And he includes compensation, which a lot of companies extract. So we're going back, instead of a multiple of revenues, and the multiple of revenues to buy a stock, looking at a multiple of that number, and how do you value it? So,
what does that mean for the market overall?
I think, with the volatility and the day trading and the speculation and the momos and the algos, last week on Tuesday and Wednesday, the market was up sharply. On Thursday and Friday, it was down sharply. There was no reason. It turned around on Thursday afternoon. This morning, we'll see, some bellwether stocks. But from my point of view, I think that as a lookout in the spring of 2023, the European economy should do better, assuming we don't hit the wrong button. And the Chinese economy is going to start improving. They just did something interesting today to kind of pull back on what they're doing in the tech stocks, and that's caused a bounce in them. But independent of that, I think the market is fairly valued even at 3.5% to 4% on the 10-year. The bigger concern for me is the runoff of the $9 trillion of the Fed. And how quickly are they going to run it off? What impact does that have on housing? Because you've got to cool things down.
And that's the only way they can stop this inflation, cool down the demand picture.
Yeah, there are other ways. But we'll see.
Okay.
We're back to the 1970s.
Oh, yay.
We did extremely well in the market, but multiples were 5 times EBITDA, not 12 times.
Right.